Ladies and gentlemen, welcome to the webinar. Today's webinar topic is incentivizing key personnel with equity alternatives. Our presenters today are attorneys Gary Forster and Kathryn Jones. If you'd like a copy of the presentation, please see the handouts section of the webinar interface. There's also a firm brochure in there for you. Without further ado, let me turn it over to our presenters. Gary, Kathryn, go ahead.
Hello, thanks for attending. We're Forster Bowman. We're a tax and corporate boutique in Greater Orlando, and we're going to today present a means of incentivizing employees to stay with the employer without the encumbrances of a stock option or similar type agreement. We have a number of business clients. We focus on business and tax work, both domestic and international. And from time to time, an owner, typically an owner of a smaller mid-sized group, will want to incentivize an employee to stay with the company for the long term without having to issue equity. For instance, if the company is family owned or very privately owned, and they have a superstar salesperson or this type of thing, they really want a means by which the person can benefit from driving the profits of the firm, driving the stability of the firm, being a valuable employee without really having to pay them anything until sale of the company. Today we're going to talk about some of the alternatives to issuing equity or a stock option plan. I'm going to turn it over to Kathryn Jones, who's our firm corporate guru in general, to give you an overview.
Thanks, Gary, and thank you all for joining us this afternoon. We're going to start with just a topical overview of what we're going to be covering today. We are really just looking at a general discussion of broad concepts. We're not going to be covering the details of the nitty-gritty on a granular level. So tax, securities, or regulatory issues are really beyond the scope of this seminar, but we may follow up if there's interest with a more detailed look at those potential issues.
Or if you have a question.
Or if you have a question, feel free to mention it or send us an email. The next broad topic is some basic terminology that we'll use throughout the presentation. And then from there, we're just going to go into the basics, the what, the who, and the why behind these equity alternative plans, the hows and the whens. We'll make some closing remarks and have some anecdotes of some recent deals that we've done with the Phantom unit plan in place, and then some Q&A at the end. For basic terminology, we'll refer to the employees or the service providers who are receiving benefits under the plan as participants. The company is the issuing entity, such as an employer, or it doesn't have to be a standard employer. It could be a independent contractor relationship between the service provider and the recipient. There are two different variations of equity alternative plans that we'll discuss today. One is the Phantom plan, and one is the Equity Appreciation Rights Plan. These two different plans generally follow the same structure except for what the participant is going to be receiving upon a change in control. So a Phantom plan is a full value benefit, whereas the Equity Appreciation Rights is a benefit based on the growth of the company or the appreciation from a certain point in time up into a sale or change in control transaction.
So a Phantom plan is basically like issuing equity to the employee. They basically enjoy a percentage interest in the company. It actually would dilute all the actual equity holders in the event of a change of control, or if you're issuing income to Phantom holders in the event of a dividend type distribution. So it's kind of a one-for-one plan. And by the way, we refer to these as plans, and the format of these Phantom or Equity Appreciation Rights plans can either be, if you have, for instance, only one or two employees, it can just be in the form of a contract where someone just is issued this right to income either during when distributions are made or upon a change in control of the company. Or you can actually do a whole plan. In other words, if you have 5, 10, 20 people that you want to create an incentive to stay with the company, you can create a plan document, which is something like, something like your 401k plan in a way. And then these employees that you choose can join the plan. And so there's a plan document that they read, and they basically sign a 2-page, 2 or 3-page piece of paper,
Right.
where they
It's very
join,
short.
right? And then
Mhm.
you show them on the piece of paper how much of the Phantom plan, at what percentage, or how many units they'll be issued. So you can do a contract, or you can do actual plan document. And what's interesting about the difference between the Phantom plan, which is just like stock, and equity appreciation, is on equity appreciation, you're saying to the employee, well, we're not going to give you a percentage. What we're going to do is we're going to just give you a percentage of the increase in value. So we're relying on you to help us raise the value of the company, and here's the percentage of that difference we're going to give you. So it's pure motivation based on day one. If they can be part of a rising tide, they're going to get a piece.
Thanks, Gary. We referred to a change in control, and we'll talk more about this later, but this is really the triggering event that would give rise to the company's obligation to pay plan benefits. And later in the seminar, we'll discuss what those events typically we're usually asked to draft. And but it's really a creature of contract, where it's whatever the company feels is appropriate for their facts and circumstances. We talk about awards. That's a grant of Phantom or EAR units. And that's, again, it's not equity, it's a contractual right to receive some payment. And then continuous service is what we're going to refer to as what the participant has to do to receive the payment upon change in control. And what basically, again, we're trying to incentivize retention and growth. So they would have to be maintaining some level of service to be eligible to receive the payout upon change in control. Next, we're moving on to the what. It's probably best just to go into what it's not. They're not true ownership interests in the company. So they're not shares in a corporation or units in an LLC. This is not ownership in the sense that they have a piece of the company.
There's no voting.
There's no voting.
And we'll get into some
right.
of the particular equity rights.
Exactly.
Yeah.
So because they're not owners of the company, they're not going to receive tax allocations of the company for tax purposes. So they're not going to receive K-1s. The tax benefits and burdens are reserved to the true equity holders.
The only exception to that would be on some of these, it's not that common anymore with the Phantom or the E or EAR rights, is that they could get a distribution. If you want to incentivize the employee to share in annual profits, part of that that non-equity participation right could be 1% of the profits. And if in fact they get 1% of the profits, it will be taxed to them as an employee, and they could be issued a K-1. I think it depends on the circumstances. If they're an employee, it would just come out as W-2 wages. But there can be a link to the earnings of the company if that's what you want to do. Typically, it really has to do with an event. Like, we're going to work until we get to a point where we can sell the company, and that's when you're going to get paid.
A second key distinction between the participants of a plan and the true equity owners is voting rights. The participants in an equity alternative plan don't have the right to participate in the management of the company, nor the right to vote, which may in some circumstances be conferred upon the owners of the company via a statute. So in Florida, we have dissenters' rights, which are triggered upon certain events like a merger or a reorg, and true equity owners would have certain rights to vote, to approve or disapprove that event, and then also to receive a fair value for payment of their equity interests. Participants, because they're not owners, don't receive those rights under the statutes. Perhaps more practical is the statutory rights to inspect and copy company records. Those are rights that are conferred upon true owners of the company. So we've listed in the materials some statutory sites in Florida for these inspection rights for LLCs, corporations, and partnerships. A key thing to remember is that this can be really cumbersome on the company to comply with these records requests. And although there are defenses available to kind of limit the scope of production, really the best defense is just to not have the rights conferred to begin with. And so one of the concerns that we see in practice is if you issue true equity to even a very small ownership percentage, that person won't have the same rights as somebody that holds a majority
Yes.
to inspect and copy records.
There's a lot of encumbrance associated with issuing actual equity. Obviously, if we have an employee who's on a non-equity plan and they're not properly paid, you can get into an argument, you can get into complaints, you can get into litigation, and as part of that litigation, demands for accounting can be made. But there's a relevancy issue there. In other words, there's going to be a particular issue and the accounting associated with that particular issue may be disclosed, and it may not be very harmful. But when you get into actual equity, the business owner is going to be subject to disclosure pursuant to that statute. And that statute is in most states very broad. So it's not like, oh, we didn't pay, he missed it by 5%, we made a mistake. It's, I want to see all your books and records now. And you could object to that if they're not equity owners, but if they're equity owners, you're going to be subject to a very, very broad disclosure requirement, which you really want to avoid.
And then there's also some exposure there to an adverse attorney's fees award if,
oh, sure.
There's a finding that the company improperly failed to comply with the request. And our litigators get this all the time. I mean, this is, a very time-consuming endeavor to respond and defend.
Those are the different
right. Those are the different formats of the statute.
Business entity.
Mm-hmm.
That they all have it.
Right. What it's not a funded plan. So there's no set aside of company assets or requirement to actually fund the plan until a change in control event occurs. So there aren't any liquidity issues created upon the adoption of the plan or the granting of awards.
It has no bank account. It has no guarantee in it, like you would a deferred compensation, like a regulated deferred compensation plan. It's simply a promise to pay if an event occurs. What's interesting about the promise is it does become a debt. A lot of clients, we have to educate on this. They don't realize that it actually does become a debt of the business. So it's not like you can't really play around with it from an exposure issue. If you have a change in control, you're going to have to pay this out. Of course, we're going to get into, and Kathryn's going to get into some detail on, well, when does the employee lose his or her rights to the change of control money, the distributions, the dividends? How does that happen? And what are the standards? Because what's good and bad about non-equity participation plans is that you make the rules. So it's kind of like an LLC. We have LLCs now, and they have operating agreements, and people are making their own LLCs. The problem is it's not like a corporation where you've got statutes governing every step of the way between the owners and the officers and directors. With LLCs, you kind of make your own thing, and because you create your own situation similar to a non-equity participation plan, you've got to really have your I's dotted and your T's crossed.
So let's talk about what it is, and Gary alluded to this earlier. It is, in its simplest form, a contractual right to receive a payment upon the occurrence of a specified event, provided that the eligibility conditions that are set forth in the plan are satisfied. And we'll get to that a little bit later, but typically if an employee leaves, they forfeit that right. They need to be employed or providing services at the time of the change in control. And this really, again, is designed to incentivize retention and maintaining those key people in positions where they can help the company grow. The payout of the plan is one of the drawbacks from the employee's perspective is the tax treatment of the payout of the plan benefits, and that is compensation. taxed as ordinary income. So we get this a lot, and really, again, because it's comp, the potential workaround is to do a gross up payment from the company to help offset the potentially increased tax liability. But again, there's, because it's not it's not an option plan in the traditional sense, there would not be capital gains treatment upon to the participant employee.
It's also much more open because it's not an option plan. It's more
Right.
flexible. It's not subject to all the Internal Revenue Code rules, the participation rules. You can't have certain equity holders involved in the stock option plan. Also, in some ways, it's more beneficial to the owner because we take it. The owner takes it. We typically represent the owner. The owner takes it as a deduction. It's just compensation payable. It's fully deductible. Although the employee, it's not quite as attractive because they've got to pay ordinary income rates as opposed to capital gains rates.
Moving on to the who and the why. Again, typically we're asked to design plans to incentivize key executive or managerial personnel who aren't already founders or owners of the company. It really could be whoever the company wants to incentivize and retain. So it could be staff level or technical employees. And I think particularly in the IT context or engineering or industries where that enterprise knowledge is really important. You want to keep the people incentivized to stay, and also just to grow the knowledge base of the company. And then also new executives. There may be a situation where a company wants to bring in an outside CEO, but they're not ready to bring them on as a full owner. So this could be kind of a way to bridge that gap to see how this person's going to work within the company without actually extending true ownership from the get-go.
Yeah, and we've seen in a number of these in the last several months that really the young executive or the salesperson, really that's what they want. They want a piece of the pie. If there's a sale, there's been so much sale activity. They're working toward a sale. They're working toward a change of control or some type of merger. And this kind of satisfies them in general. And it's not that exposing because if the person doesn't raise the values in terms of an EAR, or it doesn't work out employment-wise, it evaporates. You don't have to go through this gyration of buyout provisions. There's no, a lot of times what happens on a true equity situation is that there's an argument over value. So we want, it didn't work out, you were terminated or you left, we're buying you back out now, because you have to kind of, in general, you have to typically buy somebody back out of actual equity. There's a valuation of that equity, and there's an argument, and there's litigation. Here, it just kind of evaporates. That being said, we've come across, the more savvy employee, the more questions they're going to have, the less right the company's going to have to pull this away from them. Typically, if they leave and it's not their fault, or you force them out somehow, maybe they have the right to be paid out. If they're terminated not for cause, they might have the right. If they leave and it's not voluntary, if they leave and for some reason, their manager has been abusive or there's some kind of situation like this, you may have to actually buy them out. That really is very rare, though, with these non-equity participation plans, because people tend to move around and it's just kind of evaporates, and then the rest of the people participating continue, and they all try to work toward that end goal, that end sale, that end transaction.
And so here's a little summary of the why. We talked about long-term growth and employee retention, and I think number 2 is kind of key, is that you're mimicking the economic rights of equity ownership without the potential baggage of voting rights, record inspection rights. And from the employee's perspective, they may just care about the economic rights. They may not care so much.
Usually they just care about that.
Right. So it's a way to kind of reconcile these potentially differing viewpoints. Again, we talked about kind of who we represent for the most part. We do a lot of work for closely held business owners, and they may want to keep the equity in the family, or they want to limit ownership to some key founders, and this is a way to incentivize people who may not be within that particular group.
And before they meet us, sometimes people promise stock to these employees.
Yeah.
Don't do this. Don't do this. It's a huge mistake. We've had to work out several of these. It's so much better just to create a phantom plan, because these employees are angry, they've left, and they still have stock because they haven't sold it back. You have no right to buy them out, really, if you don't have a document. So the stock's floating around. Meanwhile, the company's grown tenfold, and it's a 7-month process to get rid of these prior employees that basically were there for the first 6 months of the company's life. This non-equity stuff's so much better because it just goes away if they leave.
Number 5 on this slide, we talk about a clean break, and I think that goes to Gary's comment, is that when somebody leaves, you want it to be as clean of a break as possible. You don't want to be dragged into a long buyout or litigation or arguments. So when we draft these plans, they're very clear that you have to be in continuous service with the company upon a change in control. It just is it's a very clean. We've seen it before where it's just basically a walk away. Whereas with a true equity ownership, it could really drag on if there is an argument, with valuation or payout.
Yeah, and as it grows in value, and the parties understand that if the employee leaves, it's a true walk away. It's really tough for that employee. It's a huge decision. I mean, sometimes you have these very creative people in some of these tech companies we represent that want to do their own thing. They may be under non-compete, but they have a completely different idea that's not subject to the non-compete or the non-solicitation. But the value of their non-equity participation rights have gone way up because they've helped, and along with the other employees, grow this thing maybe 5 or 10 times. And if they quit, they have to walk away from that. It's a great motivator to stay.
We're moving into the how and the when. So these are kind of some details as to how the plan is structured, and then also what, as a business owner, you'd want to consider when designing the plan. First and foremost is really the participant eligibility criteria. You want to figure out who you want to incentivize and how you're going to get them to stay around. Sometimes eligibility is based on tenure. If you have certain long-term employees that you want to reward for their prior service, and also you want to motivate to keep them going forward. It could be full or part-time. The eligibility could be based on metrics and performance-based goals, meeting growth targets, and also, again, position. Again, there's probably a huge variation as to what the eligibility criteria could be. The important thing is that it's uniform. You don't want to give somebody particular treatment, particularly if it's under a plan. The plan is going to be the document, and then the participants are just going to add on.
Well, it's interesting. Among the participants of that particular plan, they all just sign that same plan document. So it's just a question of how much you're going to give each one. There's no requirement, as long as this avoids the ERISA and tax rules, which it typically does, that can be avoided, for everyone to be under the same plan. You could have an executive plan, you could have a mid-management plan, you can have as many as you like. They're non-qualified plans, which means it's just treated as compensation, but basically. But that may be further. We haven't done a lot of graduated plans. We've done a few. But that it's further incentive for someone to stay, because they can enter the plan for the higher level management position and still keep their old benefits. Something to think about.
The plan would also establish a plan committee, and we would like to avoid ambiguity wherever possible. So either the people who are administering the plan should be identified in the document, either by name or by position. And we would also want to explain in the document how the committee is appointed, Again, usually the plan committees, the founding members
Mhm.
or upper level management who have been around for a long time. And these are the people who make the decisions as to who to grant the awards to, and various logistics of the plan administration.
It depends on the size of the business.
It does. It could be one person. I mean, it could
Well,
be, you know, we
sometimes
typically want more input,
management and
but, right.
owners have kind of gotten a few layers between them, and people who are hired, new hires. If it's, let's say there's 400 or 500 employees, the owners of the company aren't going to be aware of everybody who's hired, and you may have an administrator at that level to incentivize people.
We recently had a deal where our client was approached by a private equity suitor, and the client had already had a plan in place, or they had already discussed the plan with the participants. And one of the concerns that the PE suitor had was capping participation, because from their perspective, again, we talked about the dilution issue previously, is like even though they're not diluted from a voting or management standpoint, there is a practical dilution of the economic benefit of the true equity holders. So sometimes in plans we will build in a cap, either a cap on the individual participant level to ensure that somebody can't take the lion's share of the phantom units or the EAR units that are available for issuance, or an aggregate cap. And the aggregate cap issue is what came up in the deal. Is the suitor they wanted some assurance that they would not be diluted more than a certain percentage.
Well, on that deal, we had a partial buy-in, right? So the partial owner is getting, let's say, 25% of the company, and they're putting up, let's say $20 million, 20% of the company. The last thing they want is for the owner to start issuing excessive or phantom units, because it will dilute them. And another reason for the cap in that context is what ended up happening was, they had a plan in place, and maybe the cap was a little too high. And so it gets very complicated, because now if there's issuances of further non-equity participation, it only dilutes the existing owner. So the new investor, has a different class of impact associated with new issuances of phantom units. Does that blow the current S election? Does that change things tax-wise? Is that a problem from a regulatory standpoint? It becomes very complicated. So the idea, I think, what Kathryn's alluding to is, when you go into this, go into it with a lot of flexibility, allow for certain revisions of the plan, capping of the plan, etc., so that you don't scare away a potential investor or lender, really.
And we were able to we had a workaround that was something that was palatable to both sides, so it ended up being fine. But that's just an issue to be aware of, again, looking long term, because the key is working towards that change in control, the big payoff at the end. Vesting and forfeiture, these are issues. We talked earlier about a clean break, and Gary had mentioned that with savvier participants, they may not want to forfeit or be subject to forfeiture if they're not terminated for cause, and we'll get to that later. But the vesting schedule here, we give some examples of how to set up some of the vesting. They could be incremental, where they get a piece of the award every year they complete a year of service. It could be an all or nothing, where they have to stick around for a minimum amount of time to receive any benefit. In deals where we have participants who've already been with the company for a long time, the plan document could be written such that they get credit for the time that they have worked for the company before the adoption of the plan. So again, a lot of flexibility in creating vesting schedules. Here, again, the plan could be designed so awards, even after they've vested, could be subject to forfeiture upon separation of service. From the employer's perspective, you want as clean of a break as possible. However, from the employee's perspective, it may not be palatable to them to be dismissed without cause and then lose a potentially big payday at the end that they've worked so hard to achieve for the company. So these are, again, they're variations, again, that the kind of theme is we got a lot of flexibility with these plans.
Mm-hmm. Yeah, and sometimes vesting can be practically difficult to enforce if it's too long. So you have to be very careful with vesting. In other words, if someone's really put the time in and then there's a change of control event before they're fully vested, because vesting can occur over time, as Kathryn said, like you can vest in 10% a year or whatever. Or you can just, okay, if you're there for 3 years, you're completely vested, but you're not vested at all before the 3 years, and there's a change of control. You can typically expect employees to scream out if you have a big liquidation event. They're involved. They're still in the plan. They haven't done anything to cause a for-cause termination, but they're 2 weeks from vesting. You typically want to settle those matters.
And then sometimes we treat those, from a proactive standpoint in the document where you could have language that accelerates the vesting. So if you have a incremental vesting situation, let's say it's a 5-year horizon and there's a change in control in 3, the document can be written such that if the employee is still in good standing and eligible, that last 20% would vest as of the closing or immediately prior to the change in control. So there are ways to address those concerns. Here, a variation of the forfeiture is for the employee to only forfeit for cause. One of the key things here, if you decide to use a for-cause standard for forfeiture, is to really clearly define cause either in the plan itself or under the written employment or service agreement between the company and the participant. From the employee's perspective, if they are terminated right before a change in control event, they will scream and say they were squeezed out. It was arbitrary.
You can't do that.
We don't want to do that. So to avoid the allegation, you want to clearly state in the documents what constitutes cause, and then also document instances if there are performance issues that would give rise to cause, to make sure that's clearly documented in personnel files.
Okay.
And the clean break concept, again, we talked about it earlier, is to contrast it with a true equity holder. A termination of services does not automatically trigger a forfeiture or a buyout of a true equity holder. The owner is still an owner even if they're not an employee of the company. So the way we address this on the true equity side is to make sure, again, the employment and services agreements are clear as to the grounds for termination, and the operating agreement that is entered into by the true equity holder in the company would set forth buyout triggers, payment price and terms, valuation. We typically have a valuation formula in there to help avoid arguments. And again, clarity in the documents is key, whether it's a true equity holder or a phantom.
And these are the issues that you avoid with the phantom or the ear. The recovery of equity is a totally different process than the evaporation of a phantom stock right. If someone leaves, or there's clearly a for cause or whatever the trigger is to end a phantom stock right, it's kind of just moveon.com, change the unit, this phantom unit journal we like people to keep. Take the person out of the records, and there's really no notice requirements. It's really very straightforward. Whereas on the flip side, if you're actually going to issue equity, you have to have a transaction. You have to buy the person out. That's got its, it triggers these shareholder and owner / member rights with respect to accountings. And did you give me what I had bargained for? That's not what it says. There's a tremendous amount of restrictions on the company, and it's usually it can be a 2 or 3 month process, honestly. Whereas you avoid all that with the phantom. That's why we're giving the seminar. It's become very, very popular because of the practicality of it.
And the buyout mechanics aside, I mean, there could be, if they're leaving on not so great terms, it could get very emotional. And so we see that where even if the documents are clear, there's emotional turmoil.
Yeah, and let's say there's emotion and there's some
right.
ambiguity. I mean, basically what's going to happen is you've got a personal injury case on your hands where an attorney comes in, a plaintiff's attorney comes in and says, no, it doesn't say this. We think it says that. We're going to tie you up now. It's going to be 60 days. It's going to cost you $25,000 to $40,000 in litigation each month. So we want $80,000. And let me tell you, you will be so excited to cut them a check for them to go away. You will not get to the checkbook fast enough because it's such a draining, exhaustive process, the litigation. None of that is an issue with generally, I mean, almost never with the phantom.
And you got a business to run, so really,
and you got other things
to do than fight with somebody who's on their way out. So the equity alternative plan is really, it streamlines that whole exit process. Okay, up until now we've discussed concepts and features that apply to both types of equity alternative plans, the phantom plan and the EAR plan. We're going to touch on now some of the differences between these two types of plans. And really the key difference is what the participant is going to be permitted to share in upon a change in control. So with the equity appreciation rights plan, the employee or the participant would really just benefit from the growth. Part of the plan mechanics is to establish a baseline. So you determine where your starting point is. And here, really the best practices are to obtain evaluation by an expert who is experienced in valuing the type of business or the industry. The EAR plan, as far as motivation, is really better equipped to motivate for growth rather than retention. I mean, it helps with the retention as well, but if you think about it, if the benefit of the plan is based on growth, if the company is in constant decline, there's not really an element of incentive there. So the EAR plan is really, if you see your company is on a growth trajectory, you don't want to. That's probably more appropriate for you than
well, it's probably for people who would be involved in that growth.
Right.
Even on a short to midterm trajectory toward a change in control.
We have a question. Is the payout to participants always treated as ordinary income?
Yes, it is. So that's your comparison study. One of the only reasons that you still have actual stock options and equity issuances to non-control party employees is because if you want to go through the cost and time of creating a qualified stock option plan, and of course the maintenance of that plan is fairly expensive, then upon exercise of the option by the employee, it's capital gains. It's taxed as a capital gain. So that's the advantage of the true stock option plan. Typically, what we're finding over the years is we've done a number of those. It's just a little too encumbered for a small to mid-sized business. It's just a little too much to deal with. Now, if you're publicly traded or you're very large and you can devote a block of time and money to a qualified stock option plan, it may be worth it. It may be worth it because the actual benefit to the employee is substantial. It was abused in prior years by key owners in public companies. So there are restrictions on how much stock options, how many you can have if you're an insider. But beyond that, it can be very interesting and very beneficial to and with respect to a very large company, because the employees really can benefit by that, it's typically not only triggered on change of control. That option occurs typically on termination. Option can occur after a period of vesting where people cash in and out all the time. It's usually a huge amount of people. There's a journal. There's a day-to-day valuation. It's much more complicated. For the smaller mid-size, we found that this is much easier to deal with.
In contrast with the EAR plan, the Phantom plan is a full value award. Here, if the objective is to motivate retention, whether or not there's an increase or decrease in the value, the participant will receive some value if he or she remains with the company through a change in control event. So if your company is kind of stabilized or plateaued, this could still provide some incentive for the people with the value and the knowledge to hang on for the long haul. When does the company have to pay the participants? Again, this is a change in control. Commonly, it's upon a change in control. Less frequently, we see payment to participants as and when distributions or dividends are paid to the true equity holders. But by and large, my experience has been to incentivize personnel to stay on until the big sale at the end of the day. The definition of change in control can be as broad or as narrow as the company wants. Typically, we're asked to define a change in control narrowly to include a sale of the whole business to an unrelated third party. So in this slide, you'll see A through D, and there's a continuation on the next slide. These are the types of transactions that typically would not be a change in control. What you'll notice is that this is all internal things that aren't really organic growth. So a redemption, if the company's buying back equity from members, that wouldn't trigger a payout or change in control. A recap, again, we had discussed earlier a deal we had with a recap and a partial, a minority investor coming in. We would actually write the document to expressly exclude a recap as a change in control event, just to avoid any kind of confusion or misunderstanding. Cross purchases among existing equity holders, again, that doesn't really, it's not growth. There's money changing hands, but it isn't a growth or event. And then a sale of a line of business. And again, this one you could write the plan. So if you want to incentivize people who are within a particular line of business, you could write it as a trigger of a change in control upon the sale of that line. But generally speaking, we're looking at a sale of the whole company.
What I think Kathryn kind of did a good job parsing these out. The effect of the document is to basically be when everybody cashes out. Mm-hmm. If you merge with another group, that may be a change of control, right, that triggers this. But typically, we don't want to trigger the payout obligation unless everyone's getting a lot of cash. And that kind of governs the tenure of the whole document.
One of the things that we've asked to design before is a plan that would trigger a payout only if the transaction was sufficiently large. And this kind of threshold value is already built into an EAR plan, but not necessarily in a Phantom plan. So if you have a Phantom plan and you want to make sure that the transaction is something that's going to make people a lot of money, you want to build in that transaction value threshold. One of the more intricate pieces of these plan documents is the valuation language that we prepare as far as setting forth a valuation method. One of the things to consider is whether when you have a deal, there's going to be taxes and transaction costs, and are those costs to be netted out from the proceeds for purposes of valuing the payment to the participants. And from the equity owner's perspective, the answer is yes, because they're the ones that are going to be shouldering the transaction costs and things, the expenses of getting to the sale. So we typically would write in some language that the Phantom or the EAR participants would receive payment net of those transaction costs. Oh, we're on time? Okay. So this is kind of our closing remarks. Our closing remarks here. Takeaway, Phantom and EAR are not true equity, but the value of the award is tied to the value of the underlying true equity. And I had a deal where we had to kind of go over this a few times with the other counsel because there was a little bit of confusion as to the nature of these plans. But again, the key is when we are dealing with a third party, like a potential investor coming in, they're going to be concerned about dilution and their economic rights. So here, B3, we actually had this in place in a prior deal where when someone's buying into a company that has a Phantom plan, we would recommend that there be a written acknowledgement by the investor. Just, and disclosing the terms of the plan so they can't later come back and say there was some kind of obfuscation going on. So the acknowledgement is simply they're going to acknowledge they received the plan, and then the payment to the plan participants could result in an economic dilution of what they may otherwise receive upon a change in control. The same would apply in a deal where maybe the seller takes rollover equity in the buyer entity. So there's a lot of variations to this, but again, I think disclosure is key. That way everyone's communicating and understands the potential impact of the plan long term.
We have another question. Are there any restrictions on original owners taking operating distributions out of the company if the company has Phantom stock plan?
No, I don't know. There's two issues that go on with these Phantom plans. So one is, does the employee receive a percentage of the profits? So on some Phantom deals, you actually keep a share journal, and when someone's issued a percentage of Phantom, they're really economically in the same boat as someone who holds a percentage of real equity. So what does that mean? Well, what that means is we talked about shareholder rights, LLC rights, partnership rights. The common problem is that the person who's running the show pulls out a lot of salary, right? They may own 30% or they may own 51% if they're in control. And that salary draws down the profits of the company, and the people waiting for their distribution are basically disappointed with the size of their distribution. That's when the shareholder rights come into play. That's why they're written. So the shareholders then have the right to basically audit the books to figure out, number one, well, was this correct? And number two, is that a reasonable salary? Now we get into reasonable. What's the definition of reasonable? Litigation is the definition of reasonable. So you can have a Phantom that actually includes a percentage of profits. Typically it's taxable profits, but that doesn't mean you're not going to get sued by a Phantom holder for taking too much salary. They'll have less rights to find out information, but they can sue you for drawing down their distribution. We found, in the days here of private equity and the tech and the new tech boom, that the Phantom equity and the EAR are basically used for the change of control event. So you have the event, basically up until the event, the owners, the real owners of equity, they keep all the profits. They can take whatever salaries they want. They can do whatever they want. Only if there's a sale or, what we refer to as a change of control, do the Phantom people get paid. The relationship between distributions and profits and salaries and what they're paid, on a payout of a change of control, it makes it very indirect. There's not really a claim you took too much salary at that point. You have to be very careful with that salary issue. But yes, you can include it in the Phantom plan. Hope that answers that question. I kind of went around the block a little. Do we have any other questions, Tony?
Yes, we have one other question. Someone's asking if the webinar is being recorded. Yes, it is. You'll receive an email after the event, and there'll be a link in there to the webinar where you can re-listen to it.
Okay.
That's all I have.
That's all you have. That's all we have.
If anyone else has a question, please post it now. No, I think that's all we have, Gary.
Okay. All right. Well, we appreciate you listening and asking questions. We remain available. We always would like people to call us. Our names here, Kathryn and Gary, with any questions that you have, or any other corporate tax or international matters, or medical health law matters for that matter. This is how we get business. It is not an encumbrance or a bother to us at all. And we will sign off. For Kathryn, it's Gary Forster. Tony, thanks so much for organizing this.
Hey, thanks everyone. Have a wonderful afternoon. Bye-bye.